Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. In this week's episode, as a part of our 2023 Outlook podcast series, we focus on alternatives. Just as a reminder, over the past 3 weeks, we covered broader investment strategy, fixed income, and equity outlooks in our podcast series. Please take a listen to our recent episodes in case you missed them. Turning to alternatives, let's first begin by defining the opportunity set of alternatives and then delve into our strategy and outlook for 2023. So, what are alternatives? Well, it's easy to define what are not alternatives. Asset classes like stocks, bonds, and cash are considered mainstream, and anything other than these can be identified as alternatives. For example, private equity, private debt, real estate, hedge funds, commodities, natural resources, timberland and farmland, infrastructure, structured products, and collectibles can all be classified as alternatives. Alternative assets have certain key characteristics, and navigating this landscape would require specific skill sets. For example, alternatives tend to be illiquid and/or not publicly traded asset classes. This requires longer holding periods. As another example, alternatives are difficult to implement, therefore seeking professional help may be more important. Alternatives are used by large pension funds, sovereign wealth funds, endowments, and family offices as key sources of diversification. Now turning to our investment strategy, after having been neutral alternatives through 2022, we move underweight the asset class. We deploy these funds to raise fixed income to an overweight, something we discussed on our podcast 2 weeks ago. There are two macro considerations behind this move. First, we expect public markets to do well relative to private markets over the next year, as the former have already adjusted lower over the past year, and the adjustment for the latter comes with a lag of 12 to 18 months on an average. Second, within the mainstream public markets, we see value in bonds over equities over the 3-month time frame. We identify 5 key sub-asset classes within alternatives. They are real estate, commodities, hedge funds, private equity, and private debt. First, in the real estate space, the sector has gone through a difficult year in 2022 as interest rates rose sharply at a time when growth was slowing. Of course, this came after some segments of the sector experienced a strong post-pandemic rebound in the prior years. Whilst 2023 looks challenging for the sector, we think there could be opportunities after last year's correction. Even here, we prefer publicly listed and liquid segments of the real estate sector, hence our preference for public real estate investment trusts, REITs, and commercial mortgage-backed securities, CMBS. Whilst commercial real estate activity is likely to be slow in the year ahead, we think opportunities could start to emerge at some point this year. Investors with a higher risk tolerance could opportunistically focus on investing in liquid public market instruments like REITs and CMBS. Moving to commodities, in aggregate, this group has been the best performing asset class over the past 2 years. Looking ahead, it's very hard to make a case for commodity prices to rise further. Especially should inflation start to come in softer than expected, and should the growth start to weaken, commodities could become vulnerable. Within the commodity space, we prefer gold as a hedge against geopolitical risks, and on oil, we think prices are likely to be range bound this year in absence of major supply side or even demand side shocks. Turning to hedge funds, we neutral this sub-asset class in alternatives context with a retained preference for macro and market defensive strategies that worked very well last year. Macro could still provide fertile ground for hedge fund investors, especially as global growth slowdown takes hold and central bank policies diverge. We would use our preference for market defensive strategies as a hedge against any downside risk to our positions in fixed income and equities. Within private markets, a neutral stance on private debt and underweight on private equity reflects 2 of our broad preferences, that is, public markets to private markets and bonds to equities in the near term. In summary, in the long term, alternatives act as a strong source of diversification for sophisticated investors. However, more tactically, we are underweight the asset class. Within alternatives, we prefer gold, public REITs and CMBS, and macro and market defensive hedge fund strategies. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. Stay tuned for the final episode of 2023 Annual Investment Strategy Outlook. You are listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.